Right. A very good evening to all of you. Extremely sorry for the delay, to be really honest with you. I found it really difficult to log into the Zoom account this time. Then I just got a help from one of my friend. Most of you might know him. Riaz Rushad. Basically, he has been helping me with all these online classes. So I had to seek help from him to get logged back to a alternative account of him. So that's why I'm almost 50 minutes late. Hope you guys don't mind me there. Right. So this is basically the third week of us discussing MCQs this time. I sent you a paper yesterday night. I'm sorry again, I was pretty delayed to send you the paper. I should have sent it to you at least 2 weeks before, but I couldn't because of some, personal concerns. So extremely sorry for both the inconvenience that you found by getting the paper late, also tuning into the session late. So, right, let me share the paper with you for a moment. Okay. Right, let me know, is my screen visible? Can someone drop me a message in the chat box? Is my screen visible to you? I hope it is. Right, thank you, Yasmin. Thank you, Rishda. Thank you, Fatima. Thank you, Ruqayya. Thanks a lot. So guys, without wasting any time, let's get into the subject matter. So now, the first question, last time, we were looking at the definition of accounting, but this time I have curtailed it down to management accounting. So which of the following statement best describes the function of management accounting in a firm? So I did give you a little bit of a comparison between management accounting and financial accounting the first day that we met on weekly paper 1. I explained you the role of the management accountant and the role of the financial accountant. Here, what are they asking for? They're asking for the description of management accounting, right? So which of the following best describes the function of management accounting in a firm? It provides the information to shareholders. No, this is wrong. We are not providing information to the shareholders because, the information that is dealt by the management accountant, these are discrete information. These are very sensitive information. This is not given to the outsiders. Rather, the information is used by the managers. So statement 1 is wrong because we are not providing the information to the shareholders, but we are providing it to the managers. Then it provides financial information about the firm for decision making by its stakeholders. Again, no. Management accounting doesn't provide information to the stakeholders. Now, the third one, it prepares general purpose financial reports for the use of stakeholders. Again, management accountants do not provide information to the stakeholders. At the same time, they do not prepare general purpose financial statements. The statements that are prepared by the management accounting or management accountant are basically special purpose financial statement. It's not general. So wrong. Fourth, it prepares special purpose financial reports. Okay, this is correct. For the use of managers of a firm, correct. So what's your answer? Answer is basically 4. Your answer is 4th, right? Fifth one, it provides past and future information. Correct. We are providing past and future information. Cool. Again, are we providing it to the owners? No, we are not providing it to the owners. So the first question grabs the option 4 as its answers. I hope you got it correct. In case if you haven't, never mind. Just, learn through your mistakes. That's all about it, right? Second question. Prime entry book are in column X and source documents are in column Y. What is the correct answer for adjusting column Y source documents to column X prime entry books? Receipt journal. What do we record in the receipt journal? We are basically recording the cash inflows. You guys know. What do we record in the receipt journal? We are recording the cash inflow. Whenever we receive cash, where do you take it? We take it to the receipt journal. So the source document is receipt. The source document is receipt. And then we have general journal. What do we record in the general journal? Transactions that cannot be entered in any other specialized journals are included in the general journals. So what are the specialized journals we have? We have cash receipt journal, which is a specialized journal, which only take into account the cash inflows. We have the cash payment journal, which is also a specialized journal, which take into account the cash payments or the cash outflows. Then we have the purchase journal that take into account only the inventories purchased on credit. You don't take anything else except the inventories purchased on credit. And the purchase inventories are returned. It should be taken to the purchase return journal. Again, it's a specialized journal. When you sell inventories based on credit, again, it's a specialized journal, sales. And when the sales goods are returned, it has to be taken to another specialized journal, sales return. And teeny bit of transactions or petty payments needs to be recorded in a specialized journal called petty cash payment journal. So just to make things clear, keep in mind cash receipt journal, cash payment journal, sales journal, purchase journal, sales return journal, purchase return journal, and petty cash payment journal. In accounting, right? In accounting, these journals are known as specialized journals, or we call it special journals, because what do we record here? We record unique types of transactions. In each of these journals, we are recording unique types of transactions. For example, if you take cash receipt journal, it takes into account only the cash inflow. Cash payment journal, it takes into account only the cash outflow. Sales journal, it only takes into account inventory sold on credit. Do you get what I'm saying? So these are specialized journals, take into account special transactions. Only specific nature of transactions could be included in each of these journals. And then we have some transactions which are not categorized under any of these journals. We call it general transactions. For example, bad debt. Bad debt, can you take it to the cash receipt journal? No. Can you take it to the cash payment journal? No. Is it sales? No. Is it purchase? No. Is it sales return? No. Purchase return? No. Petty cash? No. So bad debt is considered as a general transaction given that it cannot be included in any of these journals. So if there is a general transaction being identified, you take it to the general journal. In case if you have forgotten, just a quick recap on it. So what is the source document that we are using to record the transactions in the general journal? Is basically journal voucher. Sales return journal, we don't want to waste time. Credit note, purchase return journal, debit note, sales journal, invoice. So what's my answer? It's C, D, and then C, D, E, C, D, E, B, A. Answer fifth, right? Your answer is basically fifth. Very good, Fatima. Very good, Umair Faiser. Properly hammered top prices. Don't worry, Umair Faiser. I'm coming for you. Right, perfect. Well done. So let's keep moving. We have the third transaction. A sales invoice of 46,000 was raised by a firm inclusive of 15% VAT. The firm keeps a gross profit margin of 20% on sales. Okay, so let's switch to the secondary camera and get this discussed. Okay, give me a minute. Okay. Guys, let me know, is my secondary camera visible to you? I hope it is. Yes, thank you. Thank you. Thank you. Let me adjust my mic a little. Okay. Thank you, Amila Faisal. That's so nice of you. Thank you. Right. So now this question that we got here, a sales invoice 46,000 was raised by a firm inclusive of 15% VAT. The firm keeps a gross profit margin of 20% on sales. The net effect of this transaction is shown in the accounting equation as right. So they are asking for the impact of this particular transaction in A equal E plus L. Right. So remember, even in the first session, I taught you, we will have the cost of inventory. To that, we will keep a profit. We will keep a profit. Isn't that true? Right? We will have cost of inventory. For that, we will keep a profit. So what do we get when we keep the profit? We will get the selling price. To that selling price, you know, VAT is charged. And eventually, what do we get? We either get cash, if not trade receivable. We get cash, if not trade receivable. So the amount given, a sales invoice of 46,000 was raised by a firm, inclusive of 15% VAT. So this 46,000, does that include VAT or does that exclude VAT? As per this question, they have stated it pretty straightforward. They have basically made it quite obvious. They are saying that this 46,000 includes VAT, which means it is not the selling price. It is basically the total amount that you either received or that is receivable. So this 46,000, it includes VAT. We all know the VAT percentage is 15. We all know the VAT percentage is 15. Okay. VAT is calculated based on the selling price. So selling price should have been 100%. Selling price should have been 100%. So for 100%, how much of VAT is charged? 15. So are we deducting VAT or are we adding the VAT to the selling price? Think about it. Are we deducting the VAT from the selling price or do we add VAT to the selling price? We are basically adding the VAT to the selling price. Therefore, the 46,000 that we got, it consists of selling price, which is 100%. It also consists of VAT, which is 15%. So what's my value? Is 115%. Now what am I supposed to do? I should do the reverse process. I should do the reverse process. How do I do the reverse process? We know 46,000 is equivalent to 115. How much is for 100? 46,000 is equivalent to 115. How much is for 100? If I do so, I will be able to travel back to the selling price. I will be able to travel back to the selling price. So what's my selling price? My selling price is going to be 40,000. That's the answer I'm going to get here. So my VAT figure is going to be 6,000. My VAT figure is going to be 6,000. Did you understand? So now, we need to find out the profit element and the cost element. We should find out the profit element as well as the cost element. How are we going to find out the profit element and cost element? Do they have given us any clue? Yes, they do. They have told us they are keeping a margin of 25%. They are keeping a margin of 25%. So the profit element here is basically 25. So the cost element needs to be 75%. Did you understand? So now we are reverse processing. What are we doing? We are reverse processing, right? So, oh, is it the profit percent is 20? Yeah, the profit percent is 20%. Give me a minute. Sorry, I made a small mistake there. The profit element is 20% and the cost element is 80%. The cost element is 80%. Now what should I do? I should reverse process. How do I reverse process? You guys know how reverse processing is done. Out of 40%, I should find out. Out of 40, I should find out the 80%, right? What's 80% for 40? I get 32,000. That's the cost of my inventory. That's the cost of my inventory. So what's the profit element? The profit element is 8,000. The profit element is 8,000. Did you understand? Okay. So now, right now, tell me what is the cost of inventory that goes out? What's the cost of inventory that goes out? Let me know. Right. Exactly right. Very good. So 32,000 worth of inventory goes out. Okay. Are we selling it for cash or are we selling it on credit basis? We are basically, it's a sales invoice, right? If it is a sales invoice, we are selling it for credit. Okay. So the trade receivable increases by 46. Look, we are selling the inventory for 32,000. That's the cost of the inventory. When we sell, what happens to the inventory? Inventory goes out. When we sell, what happens to the inventory? Inventory goes out. So 32,000 worth of inventories goes out. And are we receiving the cash? Oh, the amount is still receivable. The amount is still receivable because they have used the term invoice, which means we have sold it on credit. Do you get what I'm saying? So 46,000 is basically the trade receivable. Out of 46,000, this 6,000. Out of 46,000, this 6,000, it is a liability. This 6,000 is a liability, right? So my liability increases by 6. And this 8,000, what is it? It's a profit, which increases my equity. So my equity increases by 8. Did you understand? My equity increases by 8. So what happens? Inventory, the cost of inventory goes out, right? 32,000 worth of inventories goes out. And the total amount receivable from the customer is 46,000. Out of this 46,000, 8,000 is our profit, increases my equity. This 6,000 is basically a liability. It should be paid to the government. It is a liability. It should be paid to the government. The story is this. Selling inventory, the cost is 32,000. The customer agreed to pay us 46. Out of 46, 6 belongs to the government. Therefore, it's a liability. 8,000 is my profit. So my answer is liability goes up by 6, equity goes up by 8, and my asset goes up by 14. My asset goes up by 14. So what's the answer according to this? Right. So increase 14, increase 6, increase 2. I guess the answer is second, isn't it? Because I wasn't prepared for this paper, to be honest. I'm just doing it right now. Okay. So the answer is second. There you go. Your answer is second. Okay, very good Hafsa Razik, very good Zaima. Well done, well done. Very good Umair Farsan, Faisal. Very good Zara, very good Ruqayya. Okay, most of you have got it correct. Most of you have got it correct. Right. Now, which of the following accounting concept provides the basis for classification of assets and liabilities as current and non-current? This is something that is often tested in your past paper. If you go through past paper questions, most of the time, they are asking for this particular question, right? So what's your answer? Very good, Zaima. Right, very good, Amila, Faisal. Beautiful, Aliza. Right. Yes. All of you are correct. Let's not waste time. The answer is going concern. The answer is going concern. So what is going concern? We need to believe that we are doing the business as long as we can. We should believe that we are doing the business as long as we can. We are not fearing or we are not afraid that the business would get closed down the next year. We are not afraid that the business would get closed down the next year. A very quick example for you to understand it. So we have non-current asset. We have current asset, right? We have non-current asset and current asset. Let's say, I'm just saying here, let's say I'm buying a building to start off my business. I'm buying a building to start off my business. If I get a building to start off my business, think about it. Let's say the cost of the building is 200,000. I will directly put that building down under non-current asset. I will directly put that building down under non-current asset. Why? Because non-current assets are assets which has a lifetime more than 12 months. Isn't that true? It has a lifetime more than 12 months. So, like, tell me on what basis am I considering this building to be non-current asset? Because I know I'm going to use this building for more than 12 months. Isn't that true? I know that I'm going to use this building for more than 12 months. If I'm going to use this building for more than 12 months, listen, I should believe that I can do business as long as I can. Isn't that true? Isn't that true? Right? I should believe that I'm going to do the business as long as I can. That's why I'm considering this particular building to be of long-term existence. Imagine, I'm going to close down my business the next year. Imagine, I'm going to close down my business the next year. If I'm to close down my business the next year, can I categorize this building as non-current asset? Yes or no? If I have a plan to close down my business next year, can I show this building as a non-current asset? No, no, no. Yes, very good, Hafsa. Very good, Zaima. Very good, Larif. Well done, well done. I can't show it as a non-current asset. Why? Because now the building is going to be used less than 12 months. Do you get what I'm saying? Now the building is going to be used less than 12 months. If someone asks you why, because I'm going to close down the business next year. If I'm to close down the business next year, do you think I can categorize the building as non-current? I can't, because it has a useful lifetime less than 12 months. If so, no non-current asset, building should be treated as current asset. So that's a very quick explanation on question number 4, right? Now, the 5th question is a pretty strange question, actually. It's a pretty strange one. Okay, let's go through it. What do they tell you? The following transactions occurred during the month of March 2020 in a firm. Paid 50,000 for the purchase of office equipment at the end of the month. Made credit purchase of inventory of 20,000, out of which good costing 10,000 was sold during the month of March. Electricity bill payable for the month of March was 5,000. Owner's personal life insurance premium paid by the business was 2,000. Paid 3 months rent 36,000 at once, which begins from the month of March. What are they asking for? What are they asking for? What was the total expense to be matched with the revenue? So which concept are they trying to test here? They are trying to test the concept matching. You guys know we have this concept called matching, right? They are basically trying to test your knowledge in the matching concept. So what is a matching concept? You know, the expenses incurred with regard to gaining some income needs to be matched with that particular income, right? We will be basically generating income, right? We will be basically generating income. So to generate that income, for sure, we need to spend. You know, without spending, you can't make money. Without spending, you can't make money. So if you are basically generating some income, in order to generate that income, you should have definitely spent some money. So the amount spent needs to be matched with the amount gained through income. That's basically matching. So we are basically matching the income with the expense. We are basically matching the income with the expense. So now let's see what are the income we can match. So what's the timeline they have given us? Look, what is the timeline they have given us? The timeline is March. We are basically considering the month of March. Not beyond that, nothing less than that. Just a month of March. Just a month, which is March. Okay. So now let's go back to the tangent and let's see what are the things that could be matched. Okay. Paid 50,000 for the purchase of office equipment at the end of the month. So we are purchasing an office equipment at the end of the month. Tell me, can this be treated as a expense for the month of March? No, no, yeah, no, can't, yes, no, yes, no. Very good, Umair. Umair just beautifully made a statement. No, because it wasn't used to generate the revenue for that month. Very good, Umair. Yes, you cannot treat this as an expense. You cannot treat this as an expense. Why can't you treat this as an expense? Think about it. Now, this is the month of March. So we start at 1st and we go until 31st. When are we buying the machine? We are buying not the machine, we are buying the equipment on 31st. So did we use the equipment during this period of time? No, we didn't use it. We didn't use it. So we purchased the office equipment on 31st, which means it has to be shown as asset. In particular, non-current asset. It should be shown as a non-current asset. It cannot be, it is not used during the month of March. Answer me. If it was used in the month of March, what is the particular expense that we are going to match against the revenue generation of this office equipment? Answer me. If this office equipment was used in the month of March, what is that particular expense that we are going to basically match against the revenue generation of this office equipment? Very good, Shafa. Very good. Very good. Very good, Zaima. Beautiful, beautiful. Okay. Very good, Rashika. Amila, I think you need to check your answer a little. Very good, Hafsa. Very good, Umair. Very good. Exactly. Well done. Right. It's depreciation. What is it? It's depreciation, because you know the expense that is charged against these non-current assets, it's nothing but depreciation. Because you know, imagine I'm buying a motor vehicle. Imagine I'm buying a motor vehicle. Okay, let me switch to the secondary camera to explain this to you, because I think you would find this piece of information to be quite useful. Okay, so imagine I'm buying a motor vehicle. Imagine I'm buying a motor vehicle. So I'm going to use the motor vehicle throughout this year. Let's say I bought it on 2024. So it starts at 1st of January, ends on 31st December, right? So I'm going to use this motor vehicle. So when I purchase this motor vehicle, I'm going to consider this motor vehicle as an asset. I can't treat this motor vehicle as an expense. I will treat this motor vehicle as an asset. Okay. And through this motor vehicle, what I'm going to do, I'm going to earn income. Am I correct? I'm going to earn income. What income am I going to earn? I'm going to basically use this motor vehicle for distribution purposes. I'm going to use this motor vehicle for distribution purposes. And through distribution purposes, I'm going to make an income, which is sales. Am I correct? Through using the motor vehicle for distribution purposes, I'm going to make sales, because you know, we can use the motor vehicle to distribute the goods to the customers. We can use the motor vehicle to distribute the goods to the customers. So when we distribute goods to the consumers, we are basically selling. When we sell, we are generating an income, right? So now through the motor vehicle, indirectly we are generating sales. So this is the income. Now this income should be matched against expense. This income should be matched against expense. How do you do it? We do a separate calculation, which is depreciation, and we match that depreciation against sales as expense. Do you get what I'm saying? Now, sales that is generated through this motor vehicle, is getting matched against this expense depreciation. Did you understand? So that's basically question that most of you got it wrong. Some of you gave me some wrong answers. I didn't read it out loud because it wouldn't be nice, to read those wrong answers loud. Yeah. So 50,000 cannot be matched. Let's go for the second one. So this is wrong. Yeah, I can't match this. Made credit purchase of inventory 20,000. So we are purchasing inventory for 20,000, out of which goods costing 10,000 were sold. Am I correct? Yeah. Out of which goods costing 10,000 were sold during the month. Answer me, what is the amount that you are going to match here? Is it 20 or is it 10? Is it 20 or 10? Very good, Umair. Very good, Hafsa. Very good, Rima. Very good, Aliza. Very good, Zaima. I think, yeah, it's quite straightforward, right? So this 10,000 needs to be considered as an expense. What expense is it? Cost of sales. What expense is this? Cost of sales. You bought 20,000 worth of inventories. Out of 20,000 worth of inventories, you only sold 10,000. The remaining 10,000 is closing inventory. That's an asset. So listen to me. You bought inventory, right? You bought 20,000 worth of inventory. Out of 20,000, you sold 10. Now this 10,000 becomes a expense. What expense is this? Cost of sales. And the remaining 10,000, is it sold or unsold? It is unsold. If it is unsold, is that an expense or asset? It is a asset. What asset is this? It is current asset. Did you understand? So what's my expense here? My expense is 10,000. Okay. So I can match 10,000 there. So let me take 10,000 as one of my answer. Right. Electricity bill payable for the month of March was 5,000. Guys, the amount is not yet paid. If an expense is not yet paid, can you consider that as an expense? If an expense is not yet paid, can you consider that as an expense? Yes, 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 no, yes, can, payable, yes, yes, yes. Very good, right? All of you are correct. It is an expense, yes. Whether an expense is paid or not, you don't bloody care about that. Whether an expense is paid or not, you don't care about that, because what concept is it? It's accrual. What concept is it? It is accrual, right? Based on accrual concept, whether an expense is paid or not paid, you don't care about that. Take that as an expense. So yes, the second one could be taken too. Right. The third one, owner's personal life insurance premium paid by the business was 2,000. This cannot be taken because this is owner's personal life insurance. This is drawing. Drawing cannot be matched against the income. Paid 3 months rent for 36,000 at once, which begins from the month of March. Imagine you are paying 36,000. Okay. You are paying 36,000. So our timeline is March. After March, we've got April. We also have May. Okay. In March, we are paying 36,000. Out of 36,000, 12,000 belongs to March, 12,000 belongs to April, 12,000 belongs to May. These 24,000, is that an expense to us? No. This is not an expense to us. What is this? This is prepaid expense. Isn't that true? This is prepaid expense. So can you match it? No, you can't match it. What is it? It's an asset. The only expense is 12. The only expense is 12. Again, they are checking your accrual concept. So out of this, I can take 12,000. So we have 10K plus 5K plus 12K. That gives me 27,000. So my answer is going to be fest, isn't it? Right. Beautiful. Right. How many of you got this correct? You can raise your hands if you like. How many of you got this question correct? Very good, Zara. Okay, good, Rishda. Yeah, I could see someone with 3 dot lines. I don't know whoever it is. Rashika, very good, Yasmin. Very good, Afra. Zaima, beautiful. Zaima seems to be doing really good. Well done. Very good, Afra. Well done. Very good, Umair. Right, nice. I think some of you have got it correct, yeah? Very good, Aliza. Very good, Zakia. Very good, Harini. Right, you guys seems to be doing good. Very good, Hafsa. Very good, Hala. Nice. Right, so that's question number 5. Let's move on to question number 6 now. Cost of loose tools is completely written off as an expense in the income statement during the year of purchase, even though they can be used for more than 1 year. Under which accounting concept does this accounting treatment consistent with? It is materiality, isn't it? What is it? It is materiality concept. Very good, Zaima. Right. Why it is materiality? You guys know. When it comes to information that we provide, information can become material based on the size. Information can also become material based on the nature. Based on the size, if the size is significant, it is material. It is a material transaction. Okay, it is important. If the transaction is insignificant, which means if it is too small, is it material or immaterial? It is immaterial, right? And when it comes to nature, nature is categorized into 2 things. You might have learned this in accounting concepts. Transactions that are risky, transactions that are typical, or transactions that are non-risky. Transactions that are risky and transactions that are non-risky. So risky transactions are often material. Transactions that are not so risky are immaterial. So you must know examples for each of these. Okay, you can't be just knowing the theory. You should know. You should be able to give me one example. Okay, just tell me one example of a transaction that is significant and material. Is there anyone who can give me an answer here? Tell me a transaction which is significant in size, needs to be treated as material, needs to be treated as an important tangent. Very good, Shafa. Okay. Yes, very good. Yes. All of you are correct. Yeah. You can say like one of the best material transaction we can take is sales. There is this person named as 3 dots. He basically stated that he or she, I don't know, right? So sales can be treated as a material transaction. Non-current asset is treated as a material transaction. Cost of sales is a material transaction. Isn't that true? Right? So likewise, you should be able to relate examples for each and every, tangents. So now when it comes to loose tools, right? Loose tools, are they significant or insignificant? They are insignificant. They are very small in size. So do you consider that as a non-current asset? No, you don't consider that as a non-current asset. Rather, you treat that as an expense and write it off. Useless, right? Considering a loose tool, considering something very petty, considering something which is like very trivial, considering that as a non-current asset is in vain. Like, what's the point of taking that under non-current asset and like, basically depreciating it for about 10 to 15 years? No one would really expect that to happen, isn't it? So it's useless for you to do this. So loose tools should be treated as an expense. It's more or less like you bossing, saying that you have 2 pairs of slippers. Imagine you're about to get married. Imagine you're about to get married, okay? So now they are looking for a bride or a groom, okay? They are looking for a spouse in simple terms. So now, let's say you find a spouse to you. So now your spouse father, your father-in-law is asking, okay, what do you have, Kiela? So if they ask you of something like that, you should be able to tell some things that you got, which is significant in value. You should be able to say, sir, I have a car. Uncle, I have a car, which is big in value. He'll take that. Uncle, I have a house, big in value. He'll take that. Now his decision is getting manipulated. Oh, this guy has a car, so it's fine to get my daughter married to him. Do you get what I'm saying? Uncle, I have a big house. Again, now the decision is getting manipulated. Ah, he has a house? Seems interesting. Let's get my daughter married to him. Uncle, I have a, let's say, Rolex watch. I have this business. I have that and this and so on and so forth. Those information that you give to him, these are significant information. Building, car, Rolex watch, you know, a MacBook and an iPhone 16 Pro Max. These all significant assets you have with you, right? So that can influence your father-in-law's decision in terms of giving his daughter in marriage to you or not. You are not going to say, uncle, I have a pair of slippers, no? Uncle, I have 2 pairs of slippers, uncle. Uncle, you know, you won't be bossing, claiming that you have a pair of slipper. Who's going to give a toss on the slipper? Your father-in-law will give you a slap, you bloody idiot. You have nothing to show. So you're basically showing me your pair of slippers, Kiela. Do you get what I'm saying? So useless talking about pair of slippers, bossing about the pair of slippers you got, or bossing about a pillow that you got in your bed. Doesn't make any sense. How do you flex? You flex with the significant things. Then only you'll be able to get married. Isn't that true? Again, just a joke, okay? Just a joke. Don't take it serious. Okay. Okay. Uncle, I've got nothing. Yeah. Personally, when I was getting married, I had nothing personally. But me with my wife, I was able to build everything together. We built an empire together, you know. All credit goes to my wife in that sense. Okay. Right. So now let's move on to question number 7. Okay. We have another 20 minutes more to go. Let's go as quick as we can. Yeah. Okay, a club was formed on 1/4/2019 with 50 members, of whom 10 are life members. The monthly subscription per member is 500. In order to become a life member, 15 years subscription should be paid at once in cash. The life membership fee is recognized in income equally over a period of 15 years from the year of admission. Of the other 40 members, 10 members paid subscription for 10 months, 25 members for the 12 months, and the rest paid subscription for 18 months. Find the following for the year ended 31/3/2020. They are asking for the subscription income, and they are also asking for the subscription received in cash. Okay. Let me switch to the secondary camera one more time. This question is, in fact, a pretty difficult question, unlike the question that we attempted in our weekly paper 1. Okay, so let me erase the board for you. Right, so let's do this. A club was formed on 1/4/2019. So would they have any opening balances? No. They cannot have any opening balances because the club was formed on this year. So they just got the business started. So there cannot be any balances coming from the last year or from the previous year. So no opening balances. So to do this question, of course, you need to have a subscription account, no doubts. You got to have a subscription account, no doubts. Subscription. So we have a brought forward on our debit side, brought forward again on our credit side. We have income on our debit side, cash on our credit side, and then we have a brought down balance here, which is going to get carried down from here. We'll have a brought down balance so on the credit side, which is going to get carried down from the debit side. Okay. So a club was formed on 1/4/2019 with 50 members, of whom 10 are life members. So let's get the lifetime membership sorted. So there are two requirements, right? What are they asking for? They are asking for the cash, and they are also asking for the subscription, right? Income. They're asking for the cash. They are also asking for the subscription income. So the monthly subscription per member is 500. In order to become a life member, 15 years of subscription should be paid at once in cash. The life membership fee is recognized in income equally over a period of 15 years from the year of admission. So let's sort out the lifetime membership first. How many lifetime members do we have? We have 10 lifetime members, aren't we? How many lifetime members do we have? We have 10 lifetime members. The monthly subscription is 500. In order to become a lifetime member, they should pay 15 years of subscription at once. Okay. So, look, we have 10 life members. Each should pay 500 per month. That should get prorated to 12 months. That should get prorated to 12 months. So, 10 members, I think that's 6,000 each. They should pay for 15 years. That is the amount that we are receiving from the lifetime members. Am I correct? Right. So tell me, what is the amount that we are receiving? It's 6,000 multiplied by 10 into 15 years. That gives me 900,000. So 900,000 is the amount that I received from the lifetime members. That is the amount that I received from the lifetime members. So 10 members are there. They should pay 500 a month. So for 12 months, it's 6,000. 500 multiplied by 12, it's 6,000. 6,000 per year. To become a lifetime member, they should pay subscription for 15 years. So 6,000 multiplied by 15, you are going to get 900,000. You get what I'm saying? 10 multiplied by this 6,000, that is 60,000. 60,000 multiplied by 15 years, that's going to give you 900,000. Can you show this 900,000 as income? Answer me. You guys know this, right? This might have been learnt lately in your syllabus, right? Tell me, can you show this 900,000 as income? No, we can't show this 900,000 as income. This 900,000 is going to get divided. This 900,000 is going to get divided. Divided for how many years? They are telling the lifetime membership fee is recognized in income equally over a period of 15 years, right? It's going to get divided for 15 years. So we have 900,000 here. Divided by 15 years, what do you get? You get 60,000. 60,000 is the income that you can show right now. Out of 900,000 that you received, 60,000 is the income that you can show right now. So 900 divided by 15 years, you would be able to show only 60,000 as your subscription income. Did you understand? You will be able to show only 60,000 as your subscription income. Okay, now we are done with the lifetime membership. We are done with the lifetime membership. Now it's time for us to get the normal subscription sorted. Easy. Just go through it, okay? Okay. Of the other 40 members, 10 members paid subscription for 10 months. Okay, now I can find out the cash. We have the remaining 40 members. Out of them, 10 members paid subscription. Okay, for how many months? 10 members paid subscription for 10 months. 500 each, 10 months. 500 each, 10 months. And then 25 members paid for 12 months. 25 members, 500 per month into 12 months. Okay. And the rest. So what's the rest? 10 plus 25, it's 35, right? What's the remaining members? The members are 40. So these are normal members. So the total normal members are 40. Out of 40, 35 is done. So we have 5 more left. These people, they pay 500 for how many months? They pay for 18 months. So with this, I will be able to get the total cash sorted, right? So let's see, what do we get here? Okay, so 6,000 into 10, we get 60,000 over here. Okay, we have 500 into 12 months. Wait, I think 500 into 10, sorry, that's 5. 5 into 10 is 50,000, sorry, this is 50. Here, 6,000 into 25, that gives me 150,000. Over here, 500 into 18 months, multiplied by 5, I get 45,000. 45,000. Right. So guys, now I can find out the total cash that I received. So the total cash that I received, lifetime members paid me 900,000 should be taken. 50,000 should be taken. 150,000 should be taken. 45,000 should be taken. I will be able to get the total cash. I will be able to get the total cash. So 45 plus 150. 150 plus 50 plus 900. I get 1145. What do I get? 1,145, which is 1,145,000, right? So do we have an answer as such? We do. But then again, let's find out the subscription income as well. Let's find out the subscription income as well. Aparadine, right? So subscription income, how many members are there altogether? 40 members, right? So here we have 40 members. Each of them should pay how much? 60,000. We have 40 members. Each of them should pay 60,000. So 40 member, each of them should pay 6,000. Sorry, that gives me 240. So this 240 should also be treated as subscription income. This is lifetime. This is normal, right? So the total amount that needs to be shown as subscription is 300,000. 300,000. So your answer, 300,000, that consists of the lifetime membership income and the normal income. How did I calculate the normal income here? 40 members are there. They should pay 6,000 per month. Am I correct? 40 members, 6,000 per year. Sorry. 40 members, 6,000 per year. How did I get this 6,000? You know, 500 multiplied by 12 months. So they should pay 6,000 per year, 40 members. So they should be getting 240,000, which is my income. So there you go. Your answer is, how much is that? So your answer is basically the first one. Right, beautiful. Okay, right. How many of you got that particular question correct? Can I get a hands up? Okay, good Rishda. Good Hala, good Zaima, well done. Well done Hafsa, well done Umair. Well done Rukeya. Well done Suha, very good. Very good Harini, very good Zakia, very good Zahra. Right, beautiful. So this is in fact a pretty challenging one, but then again, not the most difficult, I must say. It's a pretty challenging one. Okay. Okay, we have 8 more minutes to go. I don't know whether we will be able to complete the last 3 questions. Let's go as fast as we can. Right. So shall we do the last 2 questions? Okay. Some of them are asking me to do the last 2 questions, which is partnership. Shall I do the last 2 questions? Is that all right? Some of you guys are requesting me to do the last 2 questions. Okay. Thank you, Samia. Thank you, Afra. Thank you, all of you. So most of you want me to do the last two questions. Let's get into this. Guys, I'll be honest with you, okay? When it comes to partnership is, trust me, it's basically the MCQ that you got in your part 1 paper, which is going to waste your time. If you take a partnership question, just go through the past paper questions that you got in partnership. Most of the questions are going to waste your time, top, right, left, center. It's going to like waste all your time. It's going to consume all your time. Okay. So I would highly recommend you guys to try the MCQ of partnership. After completing all the other MCQs, come back to it, because time is money. When it comes to accounting, you're supposed to do 50 questions. You're supposed to do 50 questions in 2 hours time. So the first basic question that you're going to get about the definition of accounting is going to carry a mark of 1. And this difficult, hammered, the most difficult question that you're doing, which is basically partnership, it is also going to carry you 1 mark. So there is absolutely no differences. Have your priorities correct. Set your priorities right. So go for the easy one first. Go for the easiest MCQs first. Trash them off and then come back to the hard one. Guess what we do? As we do questions one after the other, we come across a bloody question like partnership. Once we come across a question like partnership, we get hammered. That's basically a term by Umair. Okay. We get hammered top, right, left, center. When we get hammered, we waste about 30 minutes doing that partnership question. So if you invest 30 minutes to do one MCQ, you must be the most stupidest person. Do you get what I'm saying? You must be the most stupidest person who's basically wasting 30 minutes to gain 1 mark. Don't do that. So just keep thrashing the easiest one first. After completing the easiest one, come back to the hardest one. That way you can save up a lot of time, right? Perfect. So now, based on many requests, I'm going to skip question number 8 and move to question number 9 and 10. Mohan and Viraj are partners of a business sharing profits and losses in the ratio of 2:1. The balances of capital and current account of the partnership as at 1/4/2019 were as follows. So they have given us the opening balances of capital account and current account. Okay, now what's next? Oopsie. Okay, I'm doing the question for the first time, so I don't know whether I'm going to get this correct. Let's see. Okay, Norris joined the partnership on 1/4/2019 by contributing 1.2 million in cash. On this date, the goodwill of the partnership was estimated as 1.2 million and new profit and losses sharing ratio was agreed as 3:2:1. Okay, cool. The goodwill was not recognized as an asset in the books and all adjustments relating to the goodwill were done through the capital account of partners. Further, each partner is entitled to a monthly salary of 30,000 and 10% of annual interest on adjusted capital balances. Cool. Mohan, Viraj and Norris have taken 300, 200 and 150 respectively. The current account balance of Norris as at 31/3/2020 was 390. What was the profit of the partnership for the year ending 31/3/2020? What was the net increase of the partnership equity as at 31/3/2020? Okay, now let's do this. Seems to be a hard one. Okay, but I think we'll be able to get this sorted. Whoa, I have to shift to the secondary camera. My bad. Sorry for that. Okay. Right. Guys, tip number 1. Tip number 1. In partnership, you are not going to do tables. In partnership, MCQs in partnership MCQs, not in the part 2, okay, not in the essay part. We are basically talking about the MCQ part. In the MCQ part, you are not going to do debit and credit. Rather, you are going to add then deduct. That's what you are going to do. This is the tip for the day. This is basically the tip for the day. This is the most important takeaway that you need to grab out of this class. Okay, you are not going to debit and credit. Rather, you're going to plus and minus, or you're going to add and deduct. Tell me, capital account and current account, are they asset or liability or equity? Capital account and current account, are they asset, liability or equity? Equity, right? Yes, of course, it is equity. Correct, it is equity. So if you need to increase the equity, what are you supposed to do? You should credit. If you need to increase the equity, what are you supposed to do? You should credit. If you are to decrease the equity, you should debit. So while doing this MCQ, instead of crediting, we are going to add. Instead of debiting, we are going to deduct. That's it. That's the simple mechanism. We are not going to credit and debit. Rather, we are going to add and deduct. Instead of crediting, we are going to add. Instead of debiting, we are going to deduct. That's the bottom line. Okay, right. Now, they have given us the opening balances, right? What are the opening balances they have given us? So let me put this down first. Capital account and current account. Answer me, am I going to debit and credit? No, I'm not going to debit and credit. I'm not going to debit and credit. I'm going to put plus and minus. Okay. So we have Mohan Viraj. Mohan is there. Viraj is there. I think there is someone else joining. Who's that? I think Norris. So we have Mohan, Viraj and Norris. Okay, nice name by the way. Mohan, Viraj and Norris. Mohan, Viraj and Norris. No debit credit. More MVN, 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 MVN. No, you don't need to have two columns. We are just going to have one column. Instead of crediting, we are going to add. Instead of debiting, we are going to deduct. Okay. So now we have the opening balance of both the accounts. Right. The opening balance of Mohan is 2000 for the capital and Viraj is 1000. Norris do not have any opening balances because he's joining this year. Current account, we have 500 and then we have 300. Again, Norris do not have any balances. Again, Norris do not have any balances. Okay. Now, let's move to the additional information they have given. Norris joined the partnership on 1/4/2019 by contributing 1.2 million in cash. On this date, the goodwill of the partnership was estimated as 1.2 million and new profits and losses sharing ratio was agreed to be 3:2:1. Guys, listen to me. Now, Norris is joining. While Norris is joining, Norris is investing 1.2 million. If Norris invests 1.2 million, we are going to increase Norris balance by 1.2 million because you know, if partner invest or if partner additionally invest, it needs to be recorded in the capital account. But this time, are we going to credit it? No, we are not going to credit it. We are basically going to increase it. So instead of crediting, let's add it. Simple, easy. Okay, because we don't want to waste time, carry down, brought down, aparade for 1 mark, useless. Okay, so now capital account is increased by 1200. Now we have to adjust the goodwill. Now we have to adjust the goodwill. Like with unanimous consensus, we all can agree on one thing. What is it? If a partner was to join, goodwill needs to be adjusted based on a contra entry, right? Based on a contra entry. Now, what do I mean when I say contra entry? You are going to credit the total goodwill based on the old ratio, and you are going to debit the total goodwill based on the new ratio. Isn't that true? You credit the capital account based on the old ratio. You take the total amount of goodwill, credit the capital account based on the old ratio. When you credit, what will happen? Your capital account will increase. Am I correct? So your goodwill, what are you going to do? You are going to credit it. Are you going to credit it based on your new ratio or old ratio? You are going to credit it based on your old ratio. Based on the old ratio. And again, you are going to debit the same amount. But this time, is it based on the new ratio or old ratio? It is going to be based on the new ratio. It is going to be based on the new ratio. Right. Now, what is the total goodwill? Is 1200. The total goodwill is 1200. So, I'm going to take the total goodwill divided by the old ratio. So, what's the old ratio of this partnership? Which is basically the ratio that Mohan and Viraj was having. So Mohan and Viraj was having 2:1. So the total number of shares that we have is 3. So divide 1200 by 3, multiplied by 2, you will get Mohan. Multiplied by 1, you will get Virat. Multiplied by 2, multiplied by 2, you'll get Mohan's one. Multiplied by 1, you'll get Virat's one. So now Mohan's goodwill account is going to go up by 800. Virat's goodwill is going to go up by 400. Norris doesn't get anything. And now based on the new ratio, okay, based on the new ratio, what are you going to do? You are going to debit it. So what's the new ratio that they are talking about? Right. The new ratio is 3:2:1. So I'm going to take 1200. Okay, let me adjust the camera a little. I think we are gone out of the frame, if I'm not mistaken. Right, I hope now it's okay. Should go a little up as well. Okay. Okay, now it's cool, yeah? Right, now we have 1200. The new ratio, what is it? The new ratio is basically 3:2:1, which means 6. Okay, so out of this, 3 goes for Mohan, 2 goes for I don't know, Viraj, I guess, and then 1 goes for Norris, right? So now 600, 1200 divided by 6, it's going to be 200, 200 into 3, 600, 400, 200. But are you going to plus? No, you're going to minus because you are debiting. Am I correct? Right? Based on the old ratio, you're going to credit, and based on the new ratio, you are going to debit. So when you debit, capital account comes down. So I have indicated that with a minus. Am I correct? And when you credit, the capital account balance goes up. I have indicated that with a plus. Simple as that. Look, the goodwill adjustment is done. Easy, right? Now, Umair Faiser, I'll tell you, when it comes to goodwill, actually goodwill is a very complicated subject, and I wish I could explain the logic to you, but if I'm to explain the logic as to why the goodwill is getting credited and debited right now, I will have to spend another 30 minutes explaining that to you. So please forgive me for skipping the logic. I'm assuming all of you would have learned this with whoever the lecturer that you are learning with. So I'm assuming that you know the logic. In case if you don't know the logic, go and find it. It's quite interesting now. So Umair, like now for the time being, I will explain you the technical aspect of it. What do you need to do when it comes to goodwill? Take the total goodwill, credit the capital account based on the old ratio. Take the total goodwill, debit the capital account based on the new ratio. That is the only thing that I can explain it to you right now. I wish I could explain you the logic, but time is of the essence. Don't get me wrong. Okay. Now, but by the way, that's a nice question though. Right. Now, what else do they have told us? Now, further, each partner is entitled to a monthly salary of 30,000. Okay. Each partner is entitled to a monthly salary of 30,000. So this is not month. We are talking about the year. Salary, it increases the current account, right? So 360 Mohan, 360 Viraj, 360 Norris. 360 Norris, right? Now, 10% annual interest on adjusted capital balances. Okay, look, now we need to get the adjusted capital balance, not the opening balance. If you take it for opening balance, you are wrong. So what is the adjusted capital balance we get, which is basically the closing balance, right? So what is the closing balance we get? Here we get 1,000. Here we get 1,000. Here we get 2,800. That's 2,200 if I'm not mistaken. Yeah, right. For these figures, I should pay interest on capital. If I pay interest on capital, my current account increases. If I pay interest on capital, my current account increases. 10 for 2,200, that's 220. 10% here, it's 100. 10% here, it's again 100. 10% here is again 100, right? So there you go. Keep in mind, they are not asking you to calculate interest on capital based on the opening balance. Rather, They are asking you to calculate interest on capital based on the adjusted capital account balance. We have adjusted everything, and this is the amount that we get. So based on that only, you should be calculating goodwill. Beautiful. Now, Mohan, Viraj and Norris have taken 300,000, 200,000 and 150,000 drawing. What does it do? It decreases my current account. Decreases, right? So Mohan is taking 300, bust it down by 300. Viraj is taking 200 and then Norris is taking 150. Norris is taking 150, right? Now, the current account balance of Norris as of 31st 2020 was 390. Okay, now let's leave 1 to 2 line and we'll put the closing balance. Right, they have given us the closing balance of Norris. The closing balance of Norris is 390. The closing balance of Norris is 390. Look, here they have kept a particular tangent as the X factor. What is it? They have kept a particular tangent as the X factor. What is it? What's the X factor that they have hidden from you knowing? Very good, Harini. Very good, Suha. Very good, Zaima. Beautiful, beautiful. Like I'm so glad to get, right answers from you. Very good, Hafsa. Very good, Zahra. Adlan, how's it going? What is the hidden element? Can you figure it out? Right. The hidden element is the profit. The hidden element is the profit. Thank God they gave us this closing balance. If they have given us, if they haven't given us this closing balance, we wouldn't be able to find this figure, right? Because there are two X factors. Here there are two X factors. We don't know the closing balance. We also don't know the balance of V. We can't find it here. Here, we don't know the closing balance of Mohan. Neither do we know the profit element of Mohan. So there are two X factors. It is impossible for us to find the profit here. Impossible for us to find the profit over here as well. But here it is possible. I'm going to keep this as an X factor and I'm going to do a reverse process. How do you do a reverse process? From 390, it is added this time, minus it. It is deducted, so plus it. This is added, minus it. This is added, minus it. You're basically doing the right opposite. You're basically doing the right opposite. So you need to go reverse process. From 390, this was deducted once. Now it needs to be added. This was added once, needs to be deducted. This was added once, needs to be deducted. So what do I get? Look, we have 390. Wait, we have 390. 150 needs to be added. 100 needs to be deducted. 360 needs to be deducted. I get 80,000, which is my profit. Okay. So the profit element is what? 80. The profit element is 80. And now, based on this, I can go for these as well because you know the ratio, right? What is the ratio? The ratio is 3:2:1. Am I correct? Yeah. So the ratio is 3:2:1. So you know profit is shared based on the ratio. You know profit is shared based on the ratio. So if this 80 belongs to one share, this is going to be 160 and this is going to be 240. Did you understand? So how clean is this? No debits, no credits, no carried down, no brought down. Why are you wasting your time doing debits? And some of you are like, Mema Gahanawa, Aragena. Taking the ruler in the rough paper, you're bloody wasting your time, using your ruler to beautifully structure as if they are going to give you an Oscar award for that. Don't do that, right? Make it simple, do quick. Even these things are not necessary. I'm basically putting all these things just to, drive the point across because this is an online class. I don't even know whether you're understanding what I'm explaining to you right now. So these things are unnecessary. Just plus, minus, get the answer, go ahead with it, right? Now what are the requirements, guys? Tell me, what's the requirement now? What was the profit of the partnership for the year ending 31st 2020? Tell me what is the profit. Post it in the group. What is the profit? What is the profit element? Okay. I know most of you are going to go wrong here. That's why I'm asking. Very good, Suha. And then very good, Zakia. Well done. Very good, Hafsa, Razik. Very good, Hala. Yes. Very good. Yes. Exactly. Right. Guys, make sure that you don't go wrong here. You go wrong here, you are the most unfortunate person. Please don't go wrong here. I'll tell you why most of you are going to go wrong here. Because now you are going to take this as your profit. If you take this as your profit, you are wrong. If you take this 480 as your profit, you are wrong. Because remember, the partnership profit, right? What do? You have the net profit, right? From the net profit, you minus three things. What are those? Salary, interest on capital, and then you deduct the profit. So we need to understand the profit of the partnership consists of these three elements, not just the profit. Because this salary and interest on capital, are they treated as expense, or do they basically go through profit as a distribution? It goes through profit as an appropriation or profit as a distribution, right? So these three things are basically considered as profit. So you need to take this and then you should take these two. These all are profit, right? Don't make that mistake. I know some of you typed that out as an answer. I don't want you to go down there as well, guys. Okay. Don't make that mistake at any given scenario. So what do I get? 360. Right. So I'm getting 1908. So here it's 1500. So my total profit is how much? 1980. So that's my answer. That's answer number 4th. That's answer number 4th. Beautiful, right? I think, I hope you would have got this correct, right? Let's move on to this one. Question number 10. What was the net increase of the partnership equity? So it's again quite easy. We need to find out the net increase in equity. Let's find out the closing balances of Viraj and Mohan of the current account. It's 660. Right, I get 720 here. 860 plus 220 minus 300 plus 240 is 1020. It's 1020. So they're asking for the net increase, right? They're asking for the net increase. So let's get the total equity now. Let's get the total equity now. So the total equity, these three things, let's add this together. So it's 4,200, right? Here it's 1020 plus 720 plus 390. That gives me 2,130. So my closing equity is how much? 6,330. Because you know, the equity of partnership consists of both capital account and current account. But are they asking for the closing equity? No, they are asking for the net increase of equity, right? So Methana, how much do we get? We get 3,000. Here, how much do we get? We get 800, right? So 800 plus 3,000, what do we get? 800 plus 3,000, that's 3,800. So 3,800 increased to 6,330. So what is the net increase? The net increase is 2,530, right? The net increase is 2,530, right? Okay, right. Let's double check. Do we have an answer as such? Oh, have I made any mistake somewhere? Okay, yeah, there you go. We have answer, which is the fourth one. What is it? 2,530. There you go. Right, guys. How many of you got this correct? Like, be honest. I don't want to, just get some sugar-coated lies. Let's be honest. Okay, very good, Zahra. Zahra got it correct. Hafsa got it correct. Hala got it correct. Harini got it correct. Beautiful. Well done, well done, well done. Sir, Jazakallah, I was struggling with this. Now I got it. There you go, there you go. That's all paper classes for. That's all paper classes for. Beautiful. Right. Okay, guys. Beautiful. And again, I wasted your time, I'll be honest. Don't get me wrong. It took me almost, I don't know, 1 hour and 15 minutes to complete this, but I think it's worth it. I think it's worth it. So, not going to give you any motivational talk. Going to waste your time further. I'll let you go. So, guys, I'll see you in weekly paper 4. Until then, good night. Assalamu alaikum. Have a very, very good time. Thank you, sir. Crystal clear explanation. Thank you, Zaima. Thank you, Zaima. We'll meet you up next week. Okay? We'll come with another difficult question. Barakallah. You're welcome, Rishda. Right. Have a good time, guys. Have a good night. Thank you, Zainab Hashmi. Means a lot. Honestly, getting such feedbacks means a lot. Barakallah. May Allah bless you for, having such a kind heart to give me a feedback, Have a good time.